And we are back with our featured guest, Diana Avigdor, head of trading at Barometer Capital Management. Diana, it's been amazing to be covering this story and Todd on the ground covering the story. We've seen major moves in the commodities markets and certainly in some of the stocks. How has it affected your thinking as it relates to investing or the damage done, whether you buy the insurers, stay away from them, the energy companies? What are you doing these days with this?
We're certainly looking at some of these moving parts that you're talking about. It takes a little longer to see where you want to be. You don't know what's overdone, what isn't. Need to let it settle first. What we have been seeing and doing in the last month or two, you've seen these industrial commodities rally, zinc, copper, iron ore, that sort of thing. So where we have added some investments is things like copper, Tech B, Lundin. As it relates to the hurricane, certainly there are so many different aspects. The cost of rebuilding is now looming at $100 or $120 billion. So while some deterrent initially from growth may happen, at the end of the day, this is going to be a rebuild, and it's not only energy companies that might benefit. You have, all the industrials, things like Caterpillar, stocks of such nature. In our portfolios, our three main weights is financials, industrials, and technology. So within that,
U.S. and Canada?
Mainly U.S. Mainly
Okay.
U.S.
What percentage of the portfolio is U.S. right now versus Canada?
It depends on how much yield the portfolios are requiring to have. Certainly in full equity and global macro portfolios, almost all is U.S.
Okay.
Look, there is a lot of options, lots of winning stocks in terms of how, as you know, and we say the price action has to confirm the story for us. We buy good getting better, but we need the price action to confirm that. We're of the view that if the stock doesn't reflect what everybody seems to think about it, there's something we're missing. And yes, we missed the bottom, but
the bottom in what?
The bottom in the stock. So the stock is not acting well, but the story is fantastic. We want to make sure that we're not missing anything. We also want to manage risk.
Let me have you explain to our viewers your view of what it means when a stock price is confirming the price, or the actions confirming the price action.
So think of breadth models, and what breadth models are is stocks that are in a positive price pattern. So if you look at an index or a basket of stocks, you want more stocks to act well than not. That is a positive breadth in the market. So what happens is a price has to confirm, price has to act well. The stock has to be going up for us to buy the stock.
Higher highs and lower lows?
It doesn't have to be at a high. It can be
higher highs.
It can be on its way up or an uptrend in the stock, or it can be acting better than others. So for example, in the market of the last year, it was very low correlation market with sectors that have done fantastically well and sectors that have done nothing or really poorly. Look at retail versus technology. So technology is where you want to be. Retail, if you knew nothing, and if you never wanted to talk about Amazon, and if you never wanted to talk about online shopping, but you just looked at the price action, you wouldn't see that something's going on, and you would see that Macy's cheap, but there's something going on. So you may want to take that risk. Some people do, and that's how they make money, and stay with it 3 to 5 years thinking that you're going to stick to the same theme for so long. The price action is not confirming it yet.
So in the States, you like the financials, you like technology, and industrials.
Yep, that's our biggest weight.
In Canada, because you did say that the weighting in terms of Canada versus the United States depends on the client's need or desire for yield. If you're searching for yield in Canada, what are you buying?
Well, so the banks, of course. Some bank preferreds, of course, and financials, insurcos, that sort of thing. What happens with with more conservative portfolios, you want to take as little, as little currency risk as possible, and you're not holding on. I mean, we want capital appreciation, of course, but in terms of like the financials in Canada are a yield play, the financials in the U.S. are a yield growth play. They're not quite there yet.
Right.
You're buying them because they're cheaper, and there's all these other moving parts in terms of regulation and returning to the shareholders, but it's a yield growth story or a dividend growth story. So it depends. We want both.
What are you watching for next in terms of whether or not you put more risk on or take risk off? What's the key issue for you these days?
So I think that we're just as we speak, it's the last 2 days as the market has shown some strong reversal. We're watching to see how that resolves. Often in the sell-off, we ask ourselves, is this a dip? Is this a buyable dip? I think that in the last 2 days, what we're asking ourselves, is this a buyable rally? Will this hold? It's month end, it's thin, lots of catalysts ahead. The market has just come off a negative breadth situation a day and a half ago, midday 2 days ago. So when the US dollar started to reverse very strongly, the narrative has not changed yet. The market started pricing things in differently. So right now, what we have is we're watching. We do not have any hedges on. We've taken the hedges on. We have not yet
put
off.
Okay. You took the hedges off.
We've taken hedges off. We've had hedges on for the last month, and we've taken those off. The next step, the next leg up would be putting new money to work, but not there yet.
Okay.
Need to see confirmation of this to continue into next week ahead of very major macro catalysts, which are the Fed and the debt ceiling.
Okay, talk to me about the debt ceiling for a moment in terms of how you're analyzing it.
So the debt ceiling, it's likely going to go through, but 4 weeks in the Washington environment is a lifetime. And it seems that sentiment in the market is very strongly swayed now, because there is a feeling that President Trump needs a win to shift sentiment back to himself. In terms of the US dollar and the Fed meeting on the 20th and the debt ceiling that's looming September 29th, I think that sentiment will encompass both. And I want to make sure that it doesn't turn very negative ahead of the Fed meeting, which might then optically sway them in their narrative into the September 29th debt ceiling. So we don't know whether there's going to be another rate increase or a balance sheet normalization, but I think that market sentiment will be swayed. And as it has been last week and the week before.
Swayed, which way? Sounds like a little bit negative, and then you'll use that as a buying opportunity.
Yes.
Okay.
Exactly.
Okay.
We don't have a recession looming. Earnings has been very good. Unemployment rate, most places is fantastic, low. So we think that it would be a buying opportunity. If it would, yeah.
All right, Dana, great to be with you. Thank you very much.
Thank you very much.
Thank you.